Hello, I'm Natalie MacDonald and you're watching another Sydney Direct. As New Zealand's trade balance swings into a surplus, inflation expectations are at their lowest since 1999. I spoke to CMC Markets to find out exactly what the ins and outs are. Ric, many thanks for taking the time to chat with us today. Always appreciate it.
It's a pleasure, Natalie.
Okay, so New Zealand's trade balance has shown a swing into a surplus. Is this in keeping with sort of the general expectation that New Zealand's growth is going to remain above trend?
Well, look, the big driver behind this very good and surprisingly good figure was a large drop in imports, a 31% drop in oil imports and other one-off things like plant and machinery. So it does look like a bit of a one-off. And whilst I expect there will be an improvement in the New Zealand trade balance compared to what we've seen over the last few months, and that will make a positive contribution to GDP growth this year, I don't think it'll be as good as today's figures imply.
We also had inflation expectations earlier in the week at their lowest since 1999. Is this something we should be concerned about?
Possibly. It's a global problem, of course, not a New Zealand specific one. Most of the problem is imported in the form of lower oil prices, but also excess capacity, cheap labour around the world. The chances are, I think, as far as New Zealand is concerned, that it'll be a temporary phenomenon. I think their own economy, wage growth is going to be good enough, together with a strong housing market, to see them rise back to, more towards their trend inflation levels towards the second half of this year.
Now, the RBNZ has been described as being ever so slightly more responsive than its Australian counterpart, but with monetary conditions labelled as being pretty easy at the moment, is the Kiwi Central Bank likely to need to act really in the mid to long term?
Yeah, well, of course, it earned that reputation by virtue of its very heroic rate rising program in 2014, although you might argue it's actually been less responsive than other reserve banks recently because it hasn't cut when most of the others have. But look, it's in firmly neutral mode at the moment. I think it'll be quite a while before they act. A cut looks unlikely, not impossible, but you'd have to see a considerable deterioration in the local economy for that to occur. Like other central banks and the Fed in particular, to resume increasing rates, I think they'll want to be comfortable that inflation is heading back towards target, and that means an improvement in wage growth. And it'll be a while, I think, before we see that flowing through.
Now, as always, this does come back to money. The New Zealand dollar, what are some of the next key levels that we could see for the domestic currency?
On the upside, quite close. I think the December lows at around 76.2 cents is quite a critical level. If the market can push up through that, that'll be a sign of strength for the medium term, I think, implying that the current correction could go further, perhaps up towards around 78.5. Looking at things the other way, I'd say this week's low at 74.2 is now the next level as far as support's concerned. If we move below that implies a deeper correction back towards the 72 cent lows.
Ric, always great to chat with you. Many thanks today.
Pleasure.
Always great to catch up with the team at CMC Markets. We'll be keeping you posted on Australia's neighbouring New Zealand. For now though, it's goodbye from me.